I mean, I think I'll try and spell it out for the those who are interested in precious metals. When you have a stagflation environment, it means that inflation is rising, and the gap between what you earn on a bond and the inflation rate gets smaller and even goes negative. What that can mean is that the rate of inflation gets to the point where it's higher than you're earning on your bond interest. So right now we're getting, say, we have officially core CPE inflation at 3%, 3.0%. We have government bonds yielding 3.74%, that's something like that. So the gap is already very narrow. And if inflation rises, as seems now more and more likely, it means that gap gets smaller and smaller. In other words, the real yield, that's the yield you get after inflation, is going to shrink. Potentially, it could go negative. And if it does go negative, what that means for gold and silver holders is there's nowhere to hide. You can't go into equities because we're in a recession. Profits will start to fall. I mean, they're not falling yet, but they will start to fall despite the expectations of much higher profits from the analysts. We will have, you can't go into government bonds because with inflation running hotter than the interest rate you're going to earn, you don't want to have that. So if you can't go into stocks and you can't go into bonds, where do you go? Well, I think that's one of the options, clearly, is gold and silver.
And also, if here's a chart of gold, by the way, 51.94 at the time of this recording. And also, with the price of energy going up as well because of the Strait of Hormuz closure, it also creates a headwind against new supply coming on the market because of the increased input costs for these mining companies, doesn't it? I mean, doesn't it make it a lot harder to get gold and silver out of the ground at this point?
Well, I think with the higher price, it won't slow them down. I think anybody who's got a gold or silver mine will be running it at full capacity, even if the cost of power is, let's say, double. I don't think that's. I mean, obviously it's a factor, but at the end of the day, we've had a doubling of the gold price. We've had a tripling of the silver price. I think anybody, even though they have higher costs coming in, they're going to be running at full capacity to try and get as much as they can out to take advantage of the price at the moment.
Okay, so silver's at 88.31, gold is at 51.95. Granted, how things have transpired, shouldn't the metals be higher at this stage in the game?
I think they're reflecting the present state. We had this huge. Let's talk about silver for a minute. We had this huge run up in silver right up until the end of January, and what we now know was happening. We didn't know at the time. We were sort of speculating a bit, but what we now know is a lot of the normal buyers of silver, that would be industrial users like car manufacturers, like solar panel manufacturers, like the electronics industry, and perhaps the defense industry, they almost certainly had a lot of contracts spread over the entire spectrum of the futures from January, February, March. What now seems to have happened, a lot of those people who moved when they started to worry that they'd run out of silver or wouldn't be able to get their hands on silver, they started to move their contracts forward into January to take delivery, and took delivery in January, which caused the price to spike up right at the end because nobody was expecting so many deliveries. And the shorts got kind of squeezed at that point. So the speculation we had was that March would be the same, but it wasn't. In fact, as we went into the March month, we had a massive decline in the number of deliveries compared with a year ago. And I think that reflects the fact that a lot of the manufacturers had taken this delivery of silver in January, and were now, because they weren't worried they weren't going to get any, now they have stock and they're letting that stock run down. So we've seen a lot of rollovers into the month of May now. I mean, there's a huge open interest in May relative to the amount of silver which is at COMEX. So I think that we're kind of where we probably should be at the moment. But come May, it'll be interesting to see how much delivery is taken. What we do know, as an absolute fact, is the amount of silver at COMEX, both the registered and the eligible silver, both are dropping week after week after week. The amounts go. I mean, I think the amounts probably as low as I've ever seen it. Definitely as low as I've ever seen it. So it's going out from the CME warehouses. It's going somewhere, and I think the obvious place it's going is to the manufacturers who need it.
Clive says oil spiked to $119, then dropped on Trump's comments, but no one wants to be first through Hormuz. Employment down 1 million, population up 5 million, recession imminent, private credit redemptions accelerating. Stagflation means negative real yields. Gold and silver, the only safe havens. COMEX silver at all-time lows, draining to manufacturers. Dubai gold grounded, causing forced selling. Move slowly, but move.
So I'm not, but I can tell you I'm very optimistic about the price for gold and silver. That's a personal view, and I have my reasons for each. I think the silver reason is twofold. The first one is the simple supply and demand equation. That's not going to change. The supply is insensitive to price because most of the supply is produced as a result of producing other metals. And as far as the demand is concerned, silver is a very small part of the cost of most manufactured things. So if you're producing electronics, the amount of silver which goes into each electronic item is very, very small. So it's not really affecting the cost very much. And likewise, in a motor car, it's probably an ounce or an ounce and a half of silver. So whether you pay $20 or $150 for an ounce of silver, you're not going to change your production process and try and do something completely different for the sake of an extra $50 or $100 on a car which is costing $50,000. So the consumption of silver is inflexible, the supply is inflexible. So really it comes down to the fact that we have for many years a growing demand to consume silver from the electronics industry mainly. That gap has been growing, and we're now in negative territory since 4 or 5 years, i.e. the amount of silver being consumed exceeds the amount being mined for 4 or 5 years, and the gap is getting bigger every year. That doesn't seem to be about to change because of the price. But of course, to get the difference, you've got to have recycled silver or people selling their ETFs or selling their physical coins or bars. And the way you do that is effectively to have the price mechanism ensures the price goes high enough so the books balance at the end of the day. Was there a second part of your question, Danny, out there?
No, I think you pretty much answered it. I just asked you what would be a high conviction play for you given the current state of things.
Oh, yeah. And then I suppose the other thing is gold. I don't think anything's changed about gold. People see that, they used to see that as an inflation hedge. I think we've moved on from there. People are now saying we're now in an environment where something could happen to our currency, and we might find that what we thought we owned in monetary terms, fiat terms, won't be available because effectively if the debt is unsustainable, there comes a day when suddenly it's not there and it's replaced by something else and you don't get it. So I think people are starting to say, what's my plan B? And it's not just individuals, it's governments as well and central banks. So they're starting to say, we probably need to change the balance between our bonds and our precious metals, so we have a little bit more precious metals, a little bit less bonds. That's the direction of travel. The reality is very few wealth managers and investors see it at the moment, but I think it'll become more apparent, and then gold will, as it becomes more and more apparent that things are running out of control with government debts around the world, that effectively means that as the government has to borrow more, the likelihood is that the investors will get indigestion in the bond market. They won't be able to take any more, which then leads the Federal Reserve to step in as buyer of the last resort of government bonds. And when that happens, they're already expanding their balance sheet, but their balance sheet will expand much faster. And that means basically money printing. Because if they buy bonds, where do they get the money from? They print it out of thin air. That in itself is fueling an inflation figure, which with the core PCE at 3%, which is 50% above the Fed's target rate, it's not going to get any better, I don't think. So the Fed will have difficulty reducing their rates. I don't think they can, despite the falling unemployment. They're going to sort of, with the inflation rising, it's going to be very hard to reduce rates to cope with the falling labor. So we go into a scenario which is heading towards what I call stagflation. Stagflation is when the economy is slowing, but the rate of inflation officially announced is starting to rise.
And this is, I mean, this is tantamount to a wartime setting. There's never been a war that's not been inflationary. We're seem to be right in one.
Yeah, I mean, of course, the funny thing is, in this particular case, instead of people rushing to treasuries to buy into the safety of treasuries, we're seeing the yields on treasuries rise. That means the prices are falling. And with the rising yields, that shows that people are worrying more about the inflationary impact than they are thinking about the safety aspect of what treasuries offer, which is you don't lose any money on the stock market. I think that's been a question we've started to ask in recent weeks. First of all, we've had very, very large swings in the price, and traders, whilst they can put a bunch of silver or gold on a plane and fly it from A to B, with these sorts of swings, you don't know where the price is going to be tomorrow. And so I think what's going on, we've got to a point of dislocation in the precious metals market where the prices can be very different in different places because of the logistics of getting silver from A to B. Obviously, it's got to be, if you're getting from A to B, it's also got to be smelted into a new size bar to match the place where you're delivering it to. Because the bars in New York are not the same size as the bars in London, for example, and I guess the bars in Shanghai are different size as well. So,
Clive, are the refineries in Dubai impacted at all with respect to both metals?
Yeah, they are, because they, the way you move gold, and it's really gold we're talking about here. The way you move gold out of Dubai, and they export about 20% of the world's gold, is by air. You can't do it by sea or land. That's too risky. And of course, we've had severe disruptions over Dubai and over the Middle East as a whole, which means that there's far less flights going. So the problem with that means that the people have bought this gold from all over the world, which is going to be flown out, but it's not being flown out. So the people who own the gold now have to pay very high insurance premiums because the risk has gone through the roof. They have to pay storage costs while they're waiting for it to be shipped. So what's happening is that people who own gold, which they should have laid their hands on somewhere in London or New York, wherever it happens to be, can't lay their hands on it. They're incurring very heavy costs by keeping it where it is because they've got no choice. It can't come out. So what are they trying to do? They're trying to unload this gold as fast as they can to stop the costs from running. I mean, I don't know if you've seen what's going on with Greek debt this week. I mean, that's worth a look. If you want to bring up on Bloomberg, let's say GR10Y, you can see the yield on Greek debt has gone through the roof. I think.
Yeah, here it is.
Yeah. See now what's going on there. It's come back again today, but
yeah, but it's still elevated. That's the point.
Yeah, I mean, I think they just had a credit rating today where the credit rating of Greece was reaffirmed, but something happened, and I've tried to find out what's going on. But we've had a very large spike up in the yield from Greece in the last few days. Now, of course, Greece isn't that far from Turkey, and Turkey is obviously impacted. And if this war starts to expand a little bit, it will heavily impact the tourist industry, which is a major part of the Greek economy.
Yeah, and you can also draw like a little. I mean, you could draw like a little resistance line here, and we pretty much popped out of it, pretty much acting as support right now for the current yield level of, what is it, 3.5%. You got as high as 3.68%. So, yeah, I haven't heard anyone talk about Greece. I've seen I've been pretty much monitoring the Japanese and Korean yields, South Korean yields, but Greece is hasn't been on my radar screen. So interesting take here.
Well, although I was screwed over on holding Greek bonds, I hold nothing against Greece because it wasn't their fault, but I do hold it against the ECB, who illegally decided that the ECB should, this European Central Bank should pay themselves 100%, where leaving everybody else, private investors like myself, to go figure, because we got nothing in exchange. So that was a default on private investors, and the courts, the European courts totally agreed that the private investors had been screwed over, but they said at the end of the day, yes, you're screwed, but it was more important to save the European monetary system than save private investors, and I think that's going to happen again.
Yeah, here's the UK government bond yields as well, kind of similar to what we saw with the Greece debt market. Let's do German. We can see what's the German one? What's the ticker symbol for German?
It should be GR. No, it might be DE10Y. DE10Y.
So if you look at Germany's, yeah, same thing. So it seems like this war is impacting European debt as a whole because of the Strait of Hormuz closure, right? I mean, they get all of their, or most of their energy through that strait.
Yeah, and we've seen, obviously what's affecting countries like Germany is the price of liquid natural gas, LNG. That's, whilst oil might be up 50%, liquid natural gas is up more than 100%.